Hello students, in this video, we will discuss learning objective 2 of chapter 7 regarding alternative minimum tax, or what we call AMT. We're going to start with the AMT formula. Some taxpayers may need to pay AMT in addition to their regular federal taxes. AMT was intended to target high-income taxpayers who take advantage of excessive use of tax preference items, for example, exclusion, deferrals, and deductions, to reduce or eliminate their tax liability entirely. AMT targets the true economic income other than regular income of taxpayers to ensure some taxes are paid when AMT is greater than regular tax. This one we will look at Exhibit 7-2, page 7-10, how to calculate AMT. Regular taxable income, we will start from this one, plus personal exemptions and standard deductions if used, minus phrase out of itemized deduction. And for this one, it will depending on the nature of the adjustment, so either it will be a plus or minus item. This will equal alternative minimum taxable income minus AMT exemption, if there's any, and we'll talk about exemption later in this video, equals tax base for AMT. Then we will times the AMT rate of 20%. That will give us the tentative minimum tax. And we will compare the tentative minimum tax to our regular tax. If the tentative minimum tax is greater than regular tax, then the difference between these two, that will be our alternative minimum tax amount. Alternative minimum tax adjustment, for this one, please see Exhibit 7-4 on page 7-12 for most common AMT adjustments. And here are some of the adjustments, maybe not listed, maybe listed, all right? Plus adjustments. Number one, personal and dependency exemptions. Tax-exempt interest from private activity bonds, except for anything that's issued in 2009, 2010. Number two, state income or sales tax. Number three, real property and personal property taxes deducted as itemized deduction. And number four, home equity interest expense. And finally, number five, miscellaneous itemized deduction, which subject to a 2% floor in excess of the 2% floor. And so these items that we mentioned, these will be the plus adjustment. So this one, it will add 2. Plus or minus adjustment under depreciation. If regular depreciation is greater than AMT depreciation, then you plus it. If regular depreciation is less than AMT depreciation, then you minus it. Minus adjustments. 1, state income tax refunds included in regular taxable income. This will be a minus adjustment, which is good. Number 2, gain or loss on sale of depreciable assets. If regular tax gain greater than AMT gain due to depreciation method, this difference is a minus item. AMT accumulated depreciation is always less than regular tax accumulated depreciation. This item is never a plus adjustment. This one, please reference example 7-9 on page 7-13. AMT exemption. To protect low-income taxpayers from paying AMT, Congress allowed taxpayers to deduct AMT exemption. The AMT exemption is subject to filing status and phrase out amount on AGI. We will look at Exhibit 7-5 on page 7-13 for this AMT exemption. Also, please remember this number may change depending on the year when you are discussing this topic. Also, you want to look at example 7-10 on page 7-14 for practice. And so next we want to discuss tentative minimum tax and AMT computation. For AMT rate schedule included 2 regular brackets. This will apply to your 2014. But so please look at the tax brackets which one will apply, because every year the tax brackets may be different. Number one, 20% on the first 182,500 of AMT base for all taxpayers other than married filing separately. If they are married filing separately, then will be reduced to half amount of 182,500. So that's 91,250. Number two, 20% on AMT base in excess of 182,500 for all taxpayers other than married filing separately. This will be reduced to half of the amount. Exception. Long-term capital gain and dividends are taxed at same preferential rate as they were taxed for regular tax purposes. This one, see example 7-11 on page 7-14 and example 7-12 on page 7-15. In this 7-12 example, that's regular tax is actually less than AMT. AMT is a tax based on an alternative, more inclusive tax base than regular taxable income, meant to ensure that, well, they need to pay some minimum level of tax. And who will most likely be subject to such AMT? Higher state income taxes, multiple children, and capital gains, because some of these exclusion and also deferral items that will be added back to the regular taxable income to come to your alternative minimum taxable income. And also, why is AMT so controversial and so prevalent? Because exemption phase-out threshold is not indexed for inflation. Individual tax rate has decreased since AMT enacted. So in the beginning, there's only very small percentage of the taxpayer will be subject to this, but now they have been increased to affect even the middle class for those people who make less than $200,000 a year. So for those of you who have substantially high middle class income, you may want to be careful about your potential alternative minimum tax. So here we will conclude the learning objective 2 discussing AMT. For those of you who have questions, please post them in virtual office or under this discussion where they are assigned. Thank you.